Salesforce reported their earnings after hours yesterday, and what a report it was. As we can see with the market open, it is down around 17%, and we can see the stock trading right there now towards the lower end of its 52-week range. We're going to take a look at their earnings report to understand exactly where the issues lied, why they are down significantly, and we're also going to take a look at their investor presentation that they released yesterday to really uncover whether or not this is a massive issue. We are going to look at some of the underlying financial metrics, as always, the free cash flows and the others, and more importantly, we want to see, is this company continuing to grow their top line as well as their bottom line double digits every single year. We're also going to look at the health of this company, their total cash versus their total debt, if there are any issues that we see with this company over the short to medium term. And as always, we will look at both insiders, whether they have been buying or selling, as well as the institutions, to understand where the large money is moving with Salesforce. Now, quite importantly, with this company, they have dropped massively. We are going to run them through the valuation model. We want to get to our own intrinsic value. What is our acceptable buy price given our investor margin of safety, as well as looking towards Wall Street to see what they forecast for upside over the next 12 months. And in today's episode, we will run it through the DCF model with 3 different rates, a low, medium, and high, so you can also understand where our valuation numbers are coming from and whether or not you do agree with them. So let's just refresh ourselves of this company, their historical performance. What we do get is a double buy rating, Seeking Alpha and Wall Street, although we do get a hold from Quant. As we mentioned, it is trading now right there towards their 52-week low, and over the last 12 months, after the massive crash today, they're up just around 1.9%, but if you've been a long-term shareholder, you would be up around 330%. Now, that doesn't include those dividends reinvested, even though the dividend is very small, and we can see their all-time highs aren't in fact that long ago, around $317. Now, we're going to take a look at the PE, at their yield as well. They are slightly better than what we do see now after the crash. But let's jump into the reason for why we see this massive drop today. And we can see they say shares plunged 16% yesterday after hours, due to the fact that they did miss on their revenue for the first time since 2006. Now, key points, let's cover these when we do run through the numbers below. First thing to point out is that they did beat on the earnings per share, 244 adjusted versus 238 from what the market had anticipated. However, on the revenue, 9.13 billion, they did miss, although you could argue marginally. 9.17 was what the market was expecting. So a beat on earnings per share. Revenue, it was slightly under, but then the market has really hammered this company. They are down, in fact, nearly 20%. The other thing that we do want to point out, which we will discuss, is essentially their forecast for the next full year, and in fact they have increased it for the fiscal year of 2025. This is looking to be around 986 to 994 for the EPS, whereas in the previous quarter they were anticipating for the full year 968 to 976. So earnings per share, they have increased it. They do expect it to be larger. In terms of revenue, they do anticipate it to be roughly the same, 37.7 to around 38 billion. As we can see, the market is going to be looking for around 38.08 billion. So is it an overreaction by the market? Have they started to slow down? Let's answer all of these questions in today's episode. And let's start off with their revenue increases year on year. Typically what we do want to see 3 to 7% ideally. However, this is a company that is growing much quicker. 5.4 billion in January 2015. Latest annual accounts 35 billion. So we can see some very strong growth. In fact, nearly 7 times over the last 10 years, and this is a very nice graph. Always great to see consistent increases in companies over time, so we're already off to a good start for Salesforce. Firstly, the share price has dropped massively, so could we be looking at an opportunity to buy when the market has severely overreacted? In terms of the bottom line, well, they made a loss in January 2015, 263 million to be exact. However, in their more recent year, 4.1 billion net profit, so that is positive. But one thing we do know when we look at a more graphical basis, whilst we saw a very beautiful graph on the revenue, their bottom line is extremely inconsistent year on year. So it is a little bit of a worry, something we can take a look at their guidance as well. When we move on to the health of the company, well, their total cash and short-term investments around 1 billion in January 2015, around 17.7 from their latest quarterly report. So they do hold a lot of cash. In fact, it has been increasing over the longer term. So again, it doesn't really mean anything on its own. So let's take a look at the comparison between the total debt, both numerically and directionally. So we can see 1.5 billion in 2015, around 12.5 in their latest report. So yes, their debt has been increasing the same way their cash has been over the longer term, but in fact their cash position is much larger than their total debt, so it wouldn't even take them one day if they wanted to pay all of that off. So again, we do have a positive sign when looking very high level at their balance sheet. We then move on to their earnings, how they've performed historically, and what we note is they have a 100% track record on the earnings per share. In fact, every single one over the last 4 quarters they have beat, so a great sign there, great track record. Forward looking, well, double-digit growth anticipated over the next 3 quarters. Another great sign. Q1 2026, we do see it drop down into the single digits. And if you do take a look at the earnings per share estimate for the next 2 years, you can also see the relative forward Ps that is anticipating. Now, always good to take this and use it as part of your investment thesis, but remember their track record previously doesn't really mean much for the forward looking, but always great just to consider that as we have done today. We'll then run it through the valuation grades to understand where they sit. Currently, they do have an F grade, although this is slightly outdated when we take a look at the P non-GAAP 27.84. Right now, it is a lot lower given that massive drop. What we can see from this, however, is the sector median is around 23.66, which isn't going to be too far off when these numbers are updated for Salesforce. If you wanted to see other valuation methods, you can. For the majority of them, due to the very poor grading, they are at a much richer valuation, but you could argue others in the industry, which we will briefly cover, may not be as strong as these other ones in the sector. We then move on to the growth grade. Now they do get a B+. Year-on-year revenue growth, well, just over 11%. Sector as a whole, 3%. Forward looking, 10%, as we said, double digits with the sector at single digits. So we can already see straight away that whilst they may be at a richer valuation, they do perform as well, or in fact a lot better than the sector. We see double digit growth. And when we look forward looking, well look, earnings per share over the next 5 years is anticipated to be increasing 20.5%, whereas others just under 14%. And we can see as well on other metrics, they are looking very strong. So when we then move on then to the profitability, again, A+, I mean, this is absolutely phenomenal. Gross profit margin, 76%, sector a lot lower at 50%, and the bottom line, nearly 12% when others in the sector at 2.7%. So we can already see where the quality is lying with this company, their growth, as well as their profitability, and their cash from operations also very strong, 10.2 billion versus 91 million. So looks likely right now that the sector as a whole is not as strong as Salesforce when we do take a look at these median numbers. In terms of a quick conclusion for this part of the analysis, a double buy rating, Seeking Alpha and Wall Street with a hold from Quant, F for valuation, B+ for growth, and an A+ for profitability. Now very quickly, others in the sector, when we do look at their performance over the longer term, we have SAP, we have Adobe, Intuit, a few of these that we have covered not too long ago on the channel, so do check them out. Total return, so including those dividends reinvested, no surprises after their drop today, they're up only just 1.56%, the worst performing. When we extend it over the last 5 years, what we in fact note, again, one of the worst performing, down, or in fact just up 45%. And when we extend this to the last 10 years, well, yes, they're still in the bottom 2. Not the greatest performance, but still you could argue 329% for a 10-year period is still very decent. As always, just remember though, whatever they've done in the past doesn't necessarily have any impact on the future, but always great just to include. We then can take a look at the insider ownership. Now, a bit of a worry here because 3.2% is what it sits at, but we notice 8 instances of insider selling, and we're talking quite a hefty amount, 982 million. Constant selling by insiders over the last few quarters, as we can clearly see. If we're just looking at the more recent quarter, even 132 million, it is a very large amount. But as always, we don't believe it is typically a bearish signal, but it doesn't look like it is great. We're talking about the CEO. In fact, he just sold a few days ago before they reported their earnings, 15,000 shares at a price that is much higher than the current trading value, 4 million in total. And we can see, in fact, the CEO has sold again at the end of May. So in fact, just a week ago, as well as just a few days ago, for quite a significant amount. Interested to hear your thoughts on this, but as we can see, insiders have been selling significant amounts quarter on quarter. We then move on to the institutional ownership. 80%, as we can see here, 22 billion worth of sales by the institutions over the last 12 months, but we do see a lot more buying during the same period as well. And in fact, over the last 2 quarters, more specifically the more recent quarter, we do see more buying by institutions. So not just over 12-month period, but also over Q1 of 2024. Now, we do combine this when we look at the insiders who have been selling a lot. Regardless of what you believe about the bullish and bearish signals of each of these indicators, always do your own due diligence. Now, we just want to point you out to our free weekly newsletter. If you want to gain access to this or any others, all completely free. For example, in our latest one we just delivered yesterday, we run through some of the best recession-proof stocks. We also look at undervalued dividend stocks, as well as websites and resources we use ourselves to identify stocks to buy. And if you want access, as we mentioned in the pinned comment below, completely free, you can start reading straight away. So let's talk about their financial update that they did release. A quick look at some of their numbers, very high level. Now, the first one we want to point out, their top line revenue is still growing very nicely, double-digit growth at 11%. In terms of other revenue streams, we can take a quick look at, but it does look to be very healthy. And we can also see their operating margin is increasing. We'll take a look at their historical margins. But remember, on this channel, we do want to see increases to both top line and margins year on year, quarter on quarter as well. We then want to talk about their guidance. Now, this is very important. The first thing that we want to highlight is the next quarter, so Q2. They are anticipating an increase to what we saw around 9.13 million. But what we do note here, not just the next quarter, but also the full year guidance for FY25, they're not seeing the double-digit growth that maybe they had historically seen, something that we can discuss, but just bear in mind, sometimes companies do tend to slow down. Not all companies can continue to increase their top line double-digit year on year for the long term. So this could be one of the reasons, as well as essentially their revenue miss, why the share price has dropped. Doesn't mean it is warranted, but as always, different investors do use different things in their own investment thesis, so just bear that in mind, and we'll also talk about their margins historically as well when we do run through that shortly. In terms of their revenue growth, as we mentioned, we can see double-digit growth for every single quarter over the last 5 quarters, other than maybe the marketing and commerce, which we have seen into the single digits. Nonetheless, though, double-digit growth is one of the things Salesforce is known for, as we can see here. So just something to factor in whether or not you believe that this growth is slowing down. And one thing that we haven't discussed is, in fact, they are a very recently dividend-paying company. As we can see, they did do out recently their first ever quarterly dividend payment. And they also talk about some share repurchase that they have authorized, of which some of them they have actioned as well, which we can take a look at now. So let's jump in to the financial metrics, some of the analysis. Firstly, their yield is getting higher, as we saw on a trailing 12-month basis, 0.15%. Now it does sit at 0.72%. Market cap, 263 billion, a mega cap company. And because they've just started to pay a dividend, we don't have currently a dividend safety score. Now, in terms of their payout ratio, because they have just started to pay, it is very low, 13%. Remember, we want to see below 60% just to give us faith that they can continue to increase at double digits. This does give me very positive affirmations that moving forwards, we will see nice double-digit increases from Salesforce. And free cash flow is a very, very beautiful sight here, increasing over the longer term and pretty much every single year. In fact, what we do know here is 7 times growth over the last 10 years, and into 2025, they're anticipating more growth to the free cash flow. So lots of positive news for a very strong, essentially, shareholder analysis. In terms of sales growth, well, as we mentioned, 3 to 7% is the baseline. For this company, double digit is the name of the game, but what we can see here is that it has started to slow down, and as we saw, 2024 11%, 2025 they're anticipating 7 to 8%, so do factor that in. Yes, this company is near its 52-week low. Yes, this company does look like it has dropped significantly, but some of the reasons you need to understand and see whether or not you believe it is warranted, and we'll also use that in our margin of safety. Total sales then, just another format to what we did look at earlier, very nice increases over the longer period. However, shares outstanding, what we can in fact see here is that they have been doing share dilutions over the longer term by issuing shares. Yes, in the more recent period, as we covered, they've been doing share buybacks, but if you've been a shareholder since 2015, you would have been diluted quite significantly over the period. They have increased it by around 50% over the last 10 years. ROIC, now for me, this isn't something I like to see. I do want to see consistent 10% or more to give me faith that management can essentially allocate their capital effectively and efficiently. 8% in the more recent year, Prior to that, very, very poor. So this is one that I would say isn't too pleased about as a potential shareholder, but let me know whether or not this impacts your decision, as it may not be something you do consider that much. In terms of the operating margin, I want to see 16% or more. Yes, 2024 has been strong at 17%, but again, the previous years, it does struggle to really give me a sense that there is some consistency there. I would like to see another year or two of some very nice operating margin numbers. However, the free cash flow margin, very strong, above the 5% we do want to see, 28% in 2024, and we do see it increasing over the longer term, so that is a very good sign. Now, the net debt to EBITDA, which refers to the earnings before the interest, tax, depreciation, amortization, does show us the balance sheet strength as well as dividend safety, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. As we discussed earlier, 0 in 2024 based on their balance sheet review, 0 expected next year, and it hasn't been that high historically, so no worries with the dividend safety, which was never really in question, but we can know from a high level their balance sheet does look to be very strong. So let's jump into the DCF model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. You have the free cash flow year on year. Now what we can see is average growth rate of 31%. Now we want to go through 3 different growth rates, a low, medium and high. For today's episode we will go for a low at 8%, which we do believe these numbers are very conservative. Now with essentially this and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and based on this we do get an undervaluation signal, and we can see this implies upside of 24%. Now people will be watching this and saying 8% is way too low. Look at the previous year itself at 50%, before then 19%, average 31%. So at a 10% level we get to an intrinsic value of $318, and we can see implied upside of 42%. Now it could be warranted that even that is too low and you want to go at 12%, well that gives an intrinsic value of $366, 64% upside. So do let us know your thoughts in the comments below, what sort of growth rate you do believe to be accurate. You can always grab a copy of this valuation model so you can run your own numbers through, get your own intrinsic value and acceptable buy price that we're going to come on to. But in today's episode, let's go for the middle around 10% and take it through to our intrinsic value calculator. And because we just use the DCF model, we only believe it to be relevant, the intrinsic value does arrive at $318. Now, margin of safety, we do start off with 10%. Remember, we do execute if it meets our 3 golden criteria. A wide moat, strong financial metrics, good forward-looking data. If you believe that for CRM, well, it is a buy up to $286. And then we keep going till it's near the current trading price. And what we can see in today's episode, it is pretty much trading right there at a 30% MOS level, which for a lot of people, this may be sufficient. We did cover this not too long ago when it was at $300, and a lot of people were looking for a much lower entry. So let me know if right now is your perfect entry. In terms of Wall Street, while they still do see some upside, we have 39% in fact their price target of $310, and it could be that the market has overreacted to their very marginal revenue miss. Yes, it is the first time since a very long time, but given it is very small, is it something that maybe the market is very, very overreacting to? Or do you also believe with the slowdown in the sales growth, as we saw earlier, going from the strong double digits now to the first time expected single high digits, that it is something that could be warranted, or maybe you want to maximize and buy to this position? As always, let me know your thoughts in the comments below. If you did enjoy this episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.